Hi everyone, Harry here again with the StockMarketBasics.com. This is the introduction to the stock market video number 2. Why invest in stocks? Stocks are the growth portion of an investment portfolio. Shares in a company have the potential to appreciate or gain in value, and if you purchase shares in a company and then later on sell them for more, you will realize a capital gain on your investment which is taxed at a lower tax rate than ordinary income. The other way to make money from holding stocks is by collecting dividends. Companies that pay dividends are basically returning a portion of the profit to shareholders. Over time, this can really add up, especially if you reinvest the dividends. Dividend yield is the percentage of your investment that you get back every year from dividends. If you hold a stock that consistently pays dividends year after year for long enough, you will get your initial investment back and basically be sitting on free shares. The most exciting thing about owning stocks is the possibility of hitting a home run. These are the kinds of wins that can change your life. Individual companies can sometimes just catch fire and move up faster and further than anyone ever expected to. Happens all the time. There's always a stock out there that has doubled or even tripled in value over the last year. There's nothing more exciting than catching one of these and realizing that you made more money trading or investing than you did at your job. The markets move in repetitive cycles both up and down. These are known as either bull or bear markets and can last for 10 to 20 plus years. This chart shows the market from its beginning, that's the US market, from its beginning up until a few years ago. Look at how the market moves in a continuous direction or trends for extended time periods. If you were to zoom in on any one of these, you're going to see a lot of ups and downs that look really small on a chart that covers 130 plus years. But what you can see on this chart is how big the large movements are when a real bull market or bear market gets underway. Look at the time period from, say, 1921, right here, up until 1929. The market shot up almost 400% in 8 years. Then, over the next 3 years, it crashed all the way back down. In between these booms and busts, you get a lot of sideways action. Of course, the overall trend is up as the world population grows and economic activity grows in line with world population. But the market can just keep going in one direction for extended time periods, often 20 years. This last chart that we're going to look at is a candlestick chart. Every one of these little candlesticks represents one time period. In this case, quarters. So every one of those sticks is 3 months on this chart. So this chart covers the mid-90s up until the time of this recording, 2013. What do you notice here? We got some big runs and some pullbacks. So here, mid-90s, had a big run up until 2000. And that's when we had the dot-com bubble bursting. Market pulls back. Up we go again. Makes a new high. Financial crisis. Market plunges. Major panic. Tons of fear selling. People selling right out of the bottom. Hopefully if you were in, you got out somewhere around here and got back in somewhere around here. But a lot of people rolled this down and sold right at the bottom. And then, sure enough, reality comes back into the market. We start moving back up, a bit of a pullback. Up again we go, a bit of a pullback. And here we are on this solid run that we've had since mid-2011. New highs, breached the highs that we had in 2007, and we're in all-time high territory right here. The market has never been higher than it is right now. Is the market going to keep going for another 10, 20 years? Nah. You never know. It could. Right now it's looking like, if anything, this rally's tired and probably going to have a pullback or a period of consolidation before we have another major run up. But you just never know with the stock market. Anyone who says they know what's going to happen is most likely trying to sell you something. Ultimately, timing is everything. Don't let your emotions get the better of you and chase the market because you missed the big run up. You should be buying low and selling high. And if you're not buying low because the market is way up here already, don't overstay your welcome. Always make sure that you understand what you are investing in before you invest in it, and plan every single trade before you get in. Trading and investing is about making money, plain and simple, and we're here to help you do that. Thanks for listening, and I hope you stick around for the next video.